Hey guys, I'm Kalilah Reynolds, and it's time for another episode of Money Mondays brought to you in partnership with Proven Wealth. Now, today's topic was requested by popular demand. As you may be aware, a particular company has recently approved a rights issue. They sent out a press release about it, and there was an article in the paper. But a lot of you just didn't understand what was going on. And so you've asked me to explain what is a rights issue. Well, I'm here to serve, so here you go. First of all, a rights issue occurs when a company is issuing new shares and they're offering those shares to existing shareholders at a discount. But it's not like an initial public offer IPO where anyone can buy. You have to already be a shareholder of the company as of a certain date. So if you check the announcement and you notice that date hasn't come yet, you still have time to become an existing shareholder, but you'd have to buy at the regular price. And then after the offer opens, you can take advantage of the discounted price. Here's the caveat though. For every share you own, there's a limited amount that you're entitled to at this discounted price. So let's say it's a 3 for 10 rights issue. That means that for every 10 shares you own, you have the right to buy 3 more at the discounted price. So you can't go try jumping in and buying 100 shares at the last minute and then try to buy 10,000 more under the rights issue. If it was a 3 for 10, you'd only have rights to buy 30 more shares. Now, why do they call it a rights issue? Because they're giving existing shareholders securities called rights. And with those rights, like I said, you can buy the new shares at a discount on the stated date. So the company is giving shareholders a chance to increase their exposure to the stock at a discounted price. Now, there are also a couple of other ways to get into a rights issue if you're not an existing shareholder, but they're not guaranteed. First of all, you could get an existing shareholder to sell their rights to you. If you know someone who already has shares in the company, you could ask them, hey, are you participating in the rights offer? Maybe they don't have the cash at the time to participate. So if they say no, you could get them to sell their rights to you. And there will be others who decide not to participate, shareholders who you don't know. So if the existing shareholders don't take up all of the rights, then whatever is left over is offered to the public. So if you're feeling lucky, you could wait until that happens, if it happens, and take advantage of the deal without buying shares at the original price first. Or if you already had shares in the company, then lucky you. This is a chance to get a steal on more shares. So it's kind of like a sale. And like any other offer or any good sale, there'll be a limited time to take advantage of it. There's an open and a close date. Now, another important thing to understand about a rights issue, though, is that it means the company would now have more shares out there. So because there are more shares on the market, that tends to dilute the stock price. So after the rights issue, you might expect to see the stock price go down. Remember, there's a thing called earnings per share, EPS, and that's simply a company's earnings divided by all the number of shares in that company. So if, let's say, a company's earnings are $1 million, and there are 1 million shares in that company, then 1 million divided by 1 million equals $1. You have earnings per share, EPS, of $1. But if that same company decided to issue 1 million new shares and their earnings are still the same, they're still making $1 million, but now they have 2 million shares out there, 1 million divided by 2 million is now just 50 cents. So the EPS has fallen because of the rights issue. And EPS is directly related to dividends, those checks that you get in the mail. So you can see how that would directly relate to the price people would be willing to pay for the stock. That's the stock price. So why would a company want to do a rights issue? Well, it's a way to raise capital. Think about it. A previously unlisted company can do an IPO to raise capital. They become a publicly traded company with all the pros and cons that go with that. If you're already a listed company, obviously you can't do an IPO. It wouldn't be an initial public offer. But one of the things you can do is offer new shares, and then you're free to use that new capital, that new money you raised, for whatever it is that you needed it for, paying down debt, making new investments, expanding, making acquisitions, whatever. So depending on what the company is using the money for, like if it's for an acquisition or expansion or something like that, it could lead to increased profitability for the company in the future. So even though the rights issue might have diluted the EPS and the share price temporarily, there's a chance that could rebound. So like everything else, there are pros and cons to doing a rights issue, both for the company and for shareholders. I hope this helped to explain those benefits and risks, and you're now in a better position to make an informed decision if you want to participate in the offer that's now on the market and other offers to come. Well, that's it for this episode of Money Mondays this week, brought to you in partnership with Proven Wealth. I'm Kalilah Reynolds. See you next week.